It is Friday, April 24th, 2026, and I am streaming and recording simultaneously here. And I have done a couple recordings over the past 2 weeks, and one thing I wanted to go through that I didn't get to at all is I wanted to go through some stocks. And the past two videos that I made, uh, basically, I started talking, and I just, when it comes to the market with me, it's very easy for me to just go on a tangent and just if I have a topic that comes to mind, I start talking about it, and I just go and talk and talk and talk and talk and talk. I could talk about the market for hours. I think. Uh, and the other two videos that I made that were live recordings, basically, I I usually start, I push record, and then I start talking, and whatever, I don't have anything scripted. Whatever comes to mind, I look at the screen, or whatever I see, I go with. And I may have a few things that I kind of want to, a few topics or theses or themes or ideas that I want to talk about in the back of my mind, but I really don't have anything scripted. I'll write a few notes sometimes on my trading journal, but I don't have anything scripted. Just mainly just look at the screens, and whatever jumps out to me, I start to talk about. So one of the things that I wanted to talk about for the past two videos that I did not get to at all was I wanted to go through various individual stocks. And so today's video, today's stream, today's recording, today's video is gonna, I'm gonna try to go through some individual names, look at some individual stocks. And like I said, it was something that I've been wanting to do, but I went off on market tangents, and I just started talking about stuff that was happening with the market and missed going through individual stocks. However, I am going to start out the day and start out this video where I left off in the previous videos. And we start out here. So I will talk a little bit about the market. We start out here taking a look at the S&P 500 futures. And as you can see here, we are trading up on the day. And we take a look at this chart here, which is the past three trading sessions on the S&P 500. And what sticks out is this big yellow line. And you may ask yourself, why is there a stupid big ass ugly yellow line that goes through this chart of pretty green and red bars? And I have an answer for you. The yellow line is where we started the week. Okay, that yellow line was marked from the 5 p.m. Eastern Time close. I think it's the 5 p.m. Eastern Time close. Yeah. On last Friday. So where we closed last week trading, I marked the S&P futures. And as you can see, we're right about where we started the week. Now, if you go back in time and we look at the previous 2 and even 3 weeks, you can see that those trading weeks were completely different than what we're experiencing this week. And I'm going to click here on the Thinkorswim platform and zoom out here. Let's zoom out a little bit so we can look at some more time frames, some longer time frames. And so, let's see, I'm thinking out loud. How about 20 days, 30-minute bars? So we go back 20 days, we look at a 30-minute bar. Perfect. Okay. In this time frame, in this chart that we have here, each bar is 30 minutes, and it goes back 20 days. So as you can see here, the dotted lines mark each trading session or day, and each bar is 30 minutes. With this chart here, we can very clearly see where the market bottomed about 3 weeks ago. Is it 3 weeks ago now? Wow, it's over 3 weeks ago, because this was the bottom here, March 29th, and now it's, as you can see, April 24th. Time flies, man. So we see the clear, at the right here to the far left, you see this bear market where the market was this down move. I don't want to call it a bear market, but I want to say it was a down move, and it was very bearish. And right here on March 29th, the market bottomed, and we had a big reversal higher, 2 trading sections back to back higher. We pulled back a little bit. It has been going up constantly, nonstop. We've had some gap downs here. We had that on April 12th. We had some down moves here in the interim, but each down move, whether it was an overnight move, a gap down, or intraday pullback, has been bought aggressively. And this here is a unique way of looking at the tape action over the past, well, now over 3 weeks. This is an extended run to the upside. And over the past couple trading sessions, going back last week, going back to the 17th of April, the 16th of April, the 15th of April, it got to a point where the market was so extended to the upside. As the extended run continued, into the 10th day, 11th day, 12th day kind of thing. And I said in my previous videos that, okay, this was an extended run. We did make new momentum highs. So the playbook here is to buy any dip, to buy any pullback, to buy any sell-off. So far, that's the case. But I also said that we need some period of consolidation. So one of the things at this point, during April 15th, 16th, 17th, I had 2 kind of ideas in my mind. Are we going to get some type of sideways consolidation, or are we going to get some type of ABC pullback, or ABC pullback, where we go down, then up, then down, then up, then down, and then that gets bought? Some type of correction in that way. That would have been very bullish. And after you get an ABC type of correction down, it probably would have looked something like this. Okay, where at this point you kind of get the extended run become super extended, and then we have this down move. You have a reaction up, a lower high, then we go down again over the course of maybe a session and a half. You get another correction, right? And then we go down again. And that's where we would be right now. And that's basically an A, B, C type of correction. However, that didn't happen. For future reference, something that you can look to look for that to happen and look to buy that ABC correction. But this ABC correction that was a template for what could happen after the extended run, it didn't happen. And instead, we have traded in multiple sideways days, basically having multiple range days back to back to back to back, trading around this happy place that is where we started the week. And after 3 weeks where we traded outside the expected move, we're now trading inside the expected move, right around the price where we started the week. So it's interesting that you have, 3 weeks of, big moves up, and then you have a week where you just go sideways and volatility collapses, supposedly. And as I speak out loud, what's interesting is as the S&P has consolidated, is now going through this consolidation phase, this sideways range-bound type of tape action with multiple back-to-back-to-back range days. You take a look at the volatility futures and the VIX. Let me see. Take a look at the VIX. These are the VIX futures. Basically, you have the VIX index, which is the VIX, and then the VIX futures. The VIX futures are actually traded. And you see here, they haven't done jack crap sideways. So even though the volatility, the trading range in the underlying index has drastically come down to be in a sideways range all week, you would expect then volatility to come down because you're not having these big moves up or down. But volatility is staying pretty big for the most part. It's come down a little bit, but it's still staying elevated. So to me, that's the market saying that there's still outside risk. There's still outlier risk on the table that market participants don't want to just forget about. There's still a risk out there that something could happen. Oil, the Strait of Hormuz, Iran, Trump, who knows? But that risk premium is still baked into the market. You would expect volatility to go down as the range, the movement of the underlying stock market decreased. But as the range, the movement of this stock market has decreased over the past couple trading sessions, this has not caused the VIX and volatility to decrease. A little bit, but still, the VIX is above where it was last Friday. Yeah, go figure. So, thinking out loud, let's take a look at the skew index. And this basically shows how expensive put options are to call options. It basically shows how much hedging is going on in the marketplace right now. And since the VIX is relatively higher than what it should be, in my opinion, I think that the skew is going to be higher than you would think. I don't look at it every day, but I look at it on a regular basis. And doing this video has, forced me to look at it, which is good. What's interesting is it has come down. A little surprising. We were up above, close to the 150 range, but we have come down quite a bit. So that is interesting. And what that tells me, when you have a skew that is falling, a stock market that is consolidating its gains, yet volatility itself is not going down. Because remember, everybody misconstrues volatility. They say that it's a fear gauge, that it shows the fear of the market. No, 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 no. Volatility shows the expected move up or down. It's the expected future move from market participants for an underlying. And the VIX index is the expected move for the next 30 days for the S&P 500. Okay? And they have a new trading floor in Chicago. The Chicago Board Options Exchange opened up a new trading floor where there's physical humans trading. And basically, they just trade the SPX options and the VIX options. But they're there on the floor and they're trading. And they do lots of podcasts now there. Tasty Live broadcast there. I've seen a couple other podcasters doing broadcast there. The Nigerian brothers, I think, were there and filmed a commercial. We'll probably see them a billion times on CNBC over the next month or two. But they just got done filming there. So it's new. It's the new trading floor. They trade the SPX options and then they trade the VIX options. So you put all this together, okay? I was expecting the S&P 500, the SPY, to have a consolidation correction phase. What I didn't know, and what I was curious to find out, is whether or not it was going to have a sideways correction and form some type of flag pattern that, like we're seeing right now, as you can see here. And we'll take a look at the SPY as well, just because there's a lot of people that just look at the SPY instead of the S&P futures. You see that flag here. You got multiple gaps up. You have the nice extended run to the upside, and then you have a flag that's formed over the past couple trading days. And as we have gone throughout the week, this sideways range, this flag pattern, the low of the range is getting higher and higher. And you can make the argument that as I'm speaking, we have traded above the high from April 17th and the high from yesterday, where there was some resistance there. And now we're trading above that, and we're trading at all-time highs and highs of the day and highs of the week. We're actually breaking out a little bit to the upside as I speak. So let's zoom out here and take a look at the SPY. As you see here, this is you can see a better view here of that sideways consolidation bull flag pattern. And this is the flag. And as I said, I was looking for some type of ABC move down. That didn't happen. And we get a bull flag instead. Now we're starting to kind of, break out, try to trade to all-time highs and have a clean, solid breakout. This is probably a bad tick. We don't know for sure, but just discard that. Use this level. We're trading at new highs. We're looking to break out, but we have a nice bull flag type of pattern. In addition to that, we've had big moves down, then up. and the VIX is not going down like we would expect. Usually, when the market goes sideways, that means the move and the expected move comes down, which means the VIX should come down. It's come down a little bit, but definitely not enough in my opinion. We should be trading down here around 17 or even in the 16s. That's where we were last week. But instead, we're higher and above where we closed last Friday as the stock market goes into a sideways range. And on top of that, guess what? The skew index is coming down, which means that there's not as much hedging, there's not as much put buy happening in the SPX options, which means when you put all that together, to me, we're still in the camp where every pullback, every sell-off, every consolidation, bull flag, whatever you want to call it, needs to be bought. The trend is your friend. And go with the trend. And in this case, the trend right now is higher. And as I've talked about before, stocks go up. It's called positive drift because earnings go higher. Companies make more money as time goes on, so stocks go up. So when you have an uptrend in stocks, it means a lot more than if it's a downtrend for stocks. And we put everything together that I said before, and we take a look at the skew. It's coming back down below 140, so people are bailing out of their hedges. And to cap it all off, let's take a look at the VVIX. The VVIX is basically a measurement of how expensive the call options on the VIX are. Remember, VIX goes up when the market goes down, so these VIX calls make money when stocks sell off as the VIX goes up, and so buying VIX calls is a bearish bet and a hedge on the market. If the VVIX, and I don't check this stuff every day, I check it on a regular basis, so at the end of the week, checking this stuff, see where it's at, is a good exercise that making this video is forcing me to do, which is great. Okay, take a look at the VVIX and see how expensive these VIX calls are. I'm very curious because I think they should be. If I checked it before I checked the other stuff, I would have thought they would be higher. But looking at the skew and looking at the VIX, I bet they're going to be on the low side. And it will confirm that market participants are not as scared as they were a week or 2 weeks ago. And you should look for the market to go higher. So let's take a look. Boom! It's down. It's fallen drastically. So this orange level in the VVIX is like a red light. You know, something's wrong. It's a lot of hedging. You know, it's very bearish for stocks. It above 110 makes stocks go down more because at that level you require more hedging. It means there's a lot of fear in the marketplace. But when you come down below 100 and specifically below this yellow line, right around 95, the hedging is coming off. So basically, you put all this together, looking at the skew, looking at the VVIX, looking at the VIX, and looking at the stock market. Stock market's having a consolidation period after a huge extended run. But the way that the VVIX, the skew, and the VIX have all come down, it basically shows that, okay, yeah, the market's taking a break. It's had a huge run. It's taking a break. It's pausing. It's catching its breath. But the fear in the marketplace, the expected move, the hedging, that's come down drastically. And the fear, the hedging has come down drastically. And the fact that the VIX is staying above where it was, it means that, and the VVIX is coming down the way it is, means that, and the skew is coming down, it means that the market thinks that stocks can keep going up and make big moves up. So I love this setup here. All that being said, I got a email from someone asking me about oil stocks. Now I don't want to go into specifics of who they are, but they may watch this video, so I want to help them out. The oil stocks already made their move, and I think that the market is now looking past the war. The war itself, I don't think the actual war itself, I don't think it really cares about. You can make an argument that it's actually bullish because it means more spending on defense stocks, and what the market does care about is the Strait of Hormuz, because Strait of Hormuz is closed. That means you can't get oil. That means the risk for inflation and stagflation is higher. But the fact that they're making progress and there's a blockade and so on and so forth, the market is kind of looking through all the news and realizing, okay, this war maybe go on for a while, but Strait of Hormuz may not be an issue going forward. And earnings season is really, really good. At this point, we're looking like we're going to have somewhere around 19% earnings growth for 2026, which is fantastic, by the way. AI's really boosting productivity and earnings growth. You just got to buy stocks. So the risk of the Strait of Hormuz are going down as the VVIX goes down and as the skew goes down. Yet the stock market itself says we can make some big moves to the upside, and that's why the VIX is staying where it's at. So this is fantastic for stocks going forward. Very exciting. Now, all that said, I said that I'm going to try to look at some individual stocks. Like I said, I get on these tangents and I just talk and talk and talk and talk. So go back to the S&P. We have a bull flag formed here, and I want to also take a look at the NASDAQ, and then we'll look at some individual stocks, I promise. But you see I have this bull flag forming here in the S&P that I've talked about extensively. Let's take a look at the NASDAQ as well. We'll take a look at the SPY and the Q. There's no real flag forming in the NASDAQ. That's interesting to me. It just keeps going. It's in a true extended run, and that's probably what's keeping the VIX elevated, because we got a clear breakout to the upside, and we keep going and going and going. And it's the same story with the Russell 2000 as well. We have a little bit of a bull flag here, but it's not as pronounced as the S&P 500. Anyways, however you want to look at it, everything looks very bullish to me. Any pullback, any sell-off, any down day, any consolidation is a buy. And all that said, after my talking for easily half an hour about stuff that not everybody might enjoy, let's go on to individual stocks. So let's start out with the one, the only, and the main stock that matters to most everyone, NVIDIA. And if we take a look here, the one thing about NVIDIA is that for the past 8 months, give or take, it has been in a sideways range. And I've talked about how the stock market was in a sideways range. Well, the driving force behind that was NVIDIA. And depending on how you draw your lines, you can probably, depending on what kind of artist, how artistic you are and what kind of artist you are with the charts, you could probably go back to mid-August. At that point, we basically have not done anything since then. And we have been in a sideways range and basically been forming a classic base in the video. And we are now finally trading higher and getting very, very close to this breakout buy point, right at 211 to 212 area. And boy, do we need a clean breakout higher and then an extension higher. And going full circle, maybe the market knows that this can come, and it knows that this a clean breakout to the upside, specifically in a stock like Nvidia that takes up so much of the S&P and the Nasdaq. If it does break out above this 212 level, it will mean that the expected move in that underlying will expand drastically. You know, it could go up 8, 9, 10 points a day for a couple of days nonstop, which means what? Volatility goes higher, and that could be a reason why the VIX is staying where it is, above where it was last week. Just thinking out loud. So, we have been in this sideways consolidation period for 7 months. So you have sideways consolidation periods that last a couple days, and then they last, months. Markets alternate between range expansion and range contraction. Range expansion, range contraction. That's a basic tenet of technical analysis. And Nvidia has been in range contraction for about 1, 2, 3, 4, 5, 6, 7, 8, 9 months. 8, 9 months, depending on how you draw your lines. It is not uncommon for a stock to go through a basing period for 6, 7, 8 months, maybe sometimes 9 or 10 months after it's had an extraordinary run to the upside. It goes from a range expansion phase into a range contraction phase, but as long as the fundamentals are good, eventually it will go back into a range expansion phase. Now, let's zoom out a little bit and look at a weekly chart over 5 years. And I'm actually going to look at another chart template that I have here. Okay, so this is the chart template where we have a weekly chart here on the right and a daily chart here on the left, meaning that this is a chart for the video over the past year with daily bars, and this is a chart for the video over the past couple years with weekly bars. And as you can see here, you see this periods on when you look at the weekly, you see periods where you have sideways consolidation. We had that in late 24 into 25. Then you have periods of expansion. Then you have periods of consolidation, sideways trading. And you have periods of expansion. And then you have periods of contraction, sideways range to down. And that is how markets work. I have held Nvidia throughout this entire sideways contraction phase. Okay. I originally bought my stock like way back here in like the late teens, and so I've held it through all these sideways ranges. But doing that is how you get the big gains. Nobody talks about this, but I'll talk about it. If you can get a big winner and you can hold through those bases like we're having right now, technically still, like we had here, that's how you make the big bucks. Because when it breaks out, man, it just runs. And what's interesting is a lot of people will sell during these sideways ranges, and they'll say, oh yeah, I'll get back in, and they buy it here, but they miss out on the initial thrust up. And when you just take that, and then they get out here and they try to find a way to get back in. But after getting shaken out and then buying it back and getting out again and buying it back and paying the taxes. Don't forget that. They end up with much less gains than they expected. But when you can have a big winner and you can hold it through the basis that it forms, once it breaks out and it keeps going, you can make a killer. You can make a lot of money. So, right now Nvidia is my baby, and still hold on to it because I was looking at the fundamentals today, and Nvidia is, here's a chart. Look here on FinViz. You look at the peg. That's the main, thing that Peter Lynch says to talk about. It's 0.48, so it's still a undervalued stock. And you look at the growth rates here. For this year, it's 73%. That's fantastic. For the next year, the next 5 years, it's right around 35 to 39%, and its forward multiple is close to 19. So that's right around a 0.48 peg, 0.5 peg. It has fantastic, gross margin, profit margin, almost 56%. Everything looks stellar. So as long as the fundamentals are strong, I think that Nvidia is just been in a sideways consolidation range and is looking for a possible breakout to the upside. And we take a look at the oscillators here. You have a big move up in the rate of change, and you have a big thrust up in the fast line. So that's all very, very bullish. And we can easily see this fast line get above the previous highs from before, so that's good. And the recent history, the fast line's above these highs, so that's very, very bullish. And what's even more bullish is the slow line on the 310 oscillator is starting to turn up and is now trending up. It's going back into the positive after reaching the negative. So it went up, and then at this point the slow line started to turn down here on the weekly chart and kept going down until it reached below the zero level. And that was its objective. And once it hit the zero level, you get a big pop in momentum, and now it's turning up. So I would expect, you see how it went down negative as well here. It went more negative in that case. It was negative here. So all these bases, it peaks and then goes into the negative and then turns up. So I think we're ready to break out to the upside here, and we're getting closer and closer to earnings. So I think it's very possible to see Nvidia continue to run into earnings and break out, even whether it breaks out before earnings or just after earnings. But this level here, 211 to 212, is critical. It needs to break above that level on high volume and keep going higher. And we want to keep seeing momentum highs, keep seeing the slow line turn, and also when you look at the daily chart, see the same thing. You want to see these momentum indicators thrust back up. You want to see this slow line keep trending up. So everything looks good so far, but you got to see the follow through to new highs to prove that Nvidia can keep going higher. And if it doesn't, then it's just stuck in its sideways range consolidation basing period, which can continue for a while. But if we get a clean breakout above that 212 level, we get up thrusted momentum here, an up thrusted momentum here, that kind of stuff to prove that it keeps going higher. You you get a big thrust up in volume. Uh, you get a big volume bar and another volume bar. That's all very bullish. And it's great to see a big volume bar here as we go up like this. So there was some institutional buying today, and they're probably buying today ahead of that, key level right around the 212 level, 211 level. And you see how, the relative strength is very high too, right around 71 on the daily and 65 on the weekly. So there's still more room to go. There's still more room to go in these oscillators, and I'm perpetually bullish on NVIDIA at this point. And my research over the past week, I found that there's still a huge compute shortage. There's a compute shortage in CPUs, GPUs, memory, and energy. So the shortages have actually gotten worse to a certain extent. There's no progress being made. And the data centers are getting more and more backed up. So that's what's going on. Okay, with that said, let's take a look at some other stocks that are in these shortage areas. Let's take a look at Micron. And Micron is, in a range expansion. It went through a very short period of consolidation. And at the time, I didn't like how Micron took out this swing low here. It was able to turn and get back above this pivot here at 356. In a perfect world, I would have liked to see Micron hold that level, but it didn't. And it was kind of on watch. Once it took out that level, it had to get back above it, and then it had to break out to the upside. But we have a clean breakout here in Micron, and it is going to continue to go. It's above the 10-day moving average, so it's in an extended run. The RSI is at 68 and can keep going higher, and the weekly RSI is at 71, and that can keep going higher as well. So everything looks good for Micron at this point. On the weekly, it's super extended, but I think it still could go up because you have that compute shortage with memory. And you take a look at the the fundamentals of Micron here, and you take a look here. Stock is so cheap on a PEG basis, a valuation basis, 0.05. And the I think this is a very interesting scenario because Wall Street got it completely wrong. Memory and disk drives and so on and so forth. These are very cyclical businesses. They have their hot times and they have the cold times, and they have the hot times, they have the cold times. Because if you think about it, you have a computer, right? And you may have multiple computers. You have multiple screens and stuff. And there's a period of time on a 5-year period where you have to buy lots of electronics. You have to upgrade your phone. You have to upgrade your computer. You have to upgrade your tablet. You have to do this stuff, right? And you may have to upgrade multiple devices in a relatively short period of time. Over the course of, say, 9 months or a year, you may have to because you got to get your kids' stuff, you got to get your wife's stuff, you got to get you stuff. And now we all have multiple screens, so you have to pay, over the course of a year, or 18 months, say, you may have to buy 10 different devices or 12 different devices. And then you're good. You don't have to buy it for the year and a half to 2 years after that. You don't really have to buy anything because everybody's got their new device. And then those devices get old and break, and you have to buy new ones. That's how Micron's business has always been. It's a cyclical stock. I have watched Micron and traded it, either watched it or traded it for 20 years. Actually, I remember watching the stock in the 90s when I was a little kid. So more than that. I never traded it back then, but I was watching it on the screen. And now all of a sudden we have this AI thing where you have to They have to get all this high bandwidth memory for all these servers, for all these CPUs and GPUs. It's crazy demand. The cyclical element doesn't apply to this build out in AI. And because that's the case, Wall Street has mispriced this stock by a large amount, and it's had a huge run. But if you look at the fundamentals, you look at the growth rates, you look at the multiples, 5 times earnings with 500% earnings growth this year and 66% growth for the next year and over 100% growth for the next 5 years, you can really easily make the case that it actually has 200%, 300% earnings growth over the next 2 to 5 years. So, it's only the peg is almost zero, but it's positive, but it's almost zero. It is so undervalued, in my opinion. So, we take a look at the earnings growth. Look at this. It went from -5 in 2023, when nobody needed memory, to now we're at $21 a share estimate. 58 this year, for 2026 from 15. I mean, the growth is huge. Let's take a look at quarterly. Look at this quarterly earnings growth and sales growth. It's huge. So I think that you can still make money from this. It's already made a huge move, for sure. But we're still not done. And from the research that I do, there's still huge shortages in all areas. And the hyperscalers, they're going to have to keep spending and spending even more. The macro guys, they're not on it. I think they've completely missed the boat. They don't understand what's going on. But people that focus on individual stocks get it because they listen to the conference calls. They read articles from what's going on in the AI world. They listen to interviews of CEOs. They'll even listen to an interview on CNBC with whether it's Joe Kernan or Jim Cramer, and they understand that what CEOs and what companies are saying and what the macro guys are saying are like two different worlds. And I really don't think most analysts, specifically macro analysts, they don't quite understand what's happening. And that is that we're experiencing exponential growth in a technology. And everything has a bottleneck. So guess what? So the only way to solve the problem is to spend, baby, spend. Because if you don't, there's an existential threat. You don't want to end up like BlackBerry. And if a company doesn't spend, that possibility of that happening keeps going up and up and up every day. With all that being said, it makes sense for a company like Micron to be higher. So, the other area that I mentioned earlier that is providing a service that is a shortage, which is energy, is Bloom Energy. It's one of my favorite stocks. So NVIDIA is one of my favorite stocks for the long term. Micron obviously is one of my favorite stocks for the long term. But another one is Bloom Energy, and it's on my quote board, but I cannot. This happens to me all the time, people. I just lose the quotes. I lose the symbol. My main quote board that I look at has 62 stocks on it. It may be too much, but whatever. It's somewhere here. There it is. I may have to just type. There it is. Okay. It's down today. and it's had a recent gap up and breakout to the upside. But Bloom Energy is a special company because it provides energy to data centers and can have data centers up and running within 90 days, and no other company can really do that like Bloom Energy. So again, they've broken out to the upside. They signed a deal with Oracle, and the stock is just ripping higher. And again, it can have a pullback like Micron, but it has a gap up. It's broken out, so it has a gap and go basically formation where it basically gaps up higher, breaks out of the sideways range, and keeps going. And any pullback, I don't have it on this chart, but a pullback to the 5-day moving average is a buy. A pullback to the 10-day moving average is a buy. A pullback all the way to the 20-day is definitely a buy because it fills that gap at this point. And the fundamentals stay the same, so those will all be buy opportunities. We take a look at another chart here and look at the daily candlestick. Yeah, that 20 days right near that previous swing high and this gap level here, so that's a buy definitely. We had new momentum highs, so we made a new high on new momentum highs, and we keep going up as momentum has come down. So if we don't get a thrust up in momentum relatively soon, so we had your momentum spike, it came down and neutralized, but kept going higher. So as the Bollinger Bands expanded, I think at this point, the way momentum has come down like this, and you have a clear divergence as the stock has gone up and momentum has come down. All that is okay as long as Bloom Energy either A, takes a break and does some type of consolidation, and the momentum precedes the price, or B, you get another upthrust in momentum. Now, does it have to take out these highs? No, but it has to have an upthrust back higher to choreograph the next move up in the stock. And that makes sense, though, for me, after you have a gap and go move higher and a breakout gap and go move higher, that it should consolidate. So the fact that you get a new momentum high, and that choreographed the move that we're seeing now. Now the momentum has come down, so the longer term trend is still higher, but the next initial move makes sense to be lower. So we should see some red bars on this chart over the next couple trading sessions, because the move was so big to the upside. It needs to consolidate. And if you get some type of ABC correction, like I mentioned earlier in the video, or some type of bull flag or whatever, you buy that in Bloom Energy. Just because I think that the stock should have some type of sideways corrective action over the next week or 2 weeks or 3 weeks, that doesn't mean I'm bearish on the stock. I think the stock can easily go to 300 or 400 or 500. And with that said, let's take a look at the fundamentals in Bloom Energy. Pegs under 1. It's still inexpensive to me. This was the main thing that Peter Lynch always said to look at. And the other interesting argument to this, to price multiples and so forth, is that someone like Bill O'Neill, who ran Investors Business Daily, who I have high regard for, he said himself, don't look at multiples as being high multiples as being bearish. He said high multiples can actually be very often bullish. You get the expansion in the multiple, the stock goes up. And to justify what he means by that, like how is that possible, right? When the multiples go up like this, so 74 in itself is a high multiple by itself. Just looking at 74 by itself is a high multiple because as a benchmark, the S&P is at around 20, so 74 is high. Just looking at the PE multiple by itself. However, when you look at it in conjunction with the growth rates, it's perfectly fine. You have this year's 86, so this year's growth rate's very solid. Now we can't compare this year's growth rate with a trailing multiple for some reason. That data isn't there, but that's what I like to do. We look at next year, 122%. Next 5 years, 86%. Both are above 74. So I like to look at them individually, but also blend them together. That's about a 90% growth rate for the out years. And you have a 74 PE multiple. It's cheap, in my opinion. Take a look at these bars. Look at this. The EPS is slowly. It's still the company still is not making money on an annual basis, but it's getting close to being a profitable company. And the sales is fantastic to the upside. So I think everything is fantastic. And these data centers need the Bloom Energy technology. So I like it, and I'm bullish on it. I think if you don't have it already, you missed it for now with a gap and go breakout to the upside. But the fact that the momentum is kind of coming down and mean reverting, that tells me that we're due for some type of consolidation in the stock. And your key levels to look at are 178 for a pullback. That's the 20-day. And we take a look at the other chart here. We got the 20-day at 178. If you really want to wait and be super patient, like the 50-day is 163, but that 213 10-day that works as well if you want to be aggressive. So those are some key levels to take a look at to buy this stock. Let's see what else do I want to take a look at. One other stock that jumps out to me, really jumps out to me. Vertiv has made a nice move. Vertiv makes they make all these components for data centers, and this stock had a fantastic move to the upside, and I think the closing bell scared me. It's had a nice huge move to the upside, a gap higher, and has continued to go up and up and up, and any pullback to the 10-day I think is a buy. It's an extended run. It's held the 50-day, it got back above the 20-day, and the 10-day had a gap higher, and I think any pullback specifically to this 10-day or even this 20-day are buy points for Vertiv, and they make all this different technology for data centers. HVAC systems, servers, cooling systems, all types of stuff, power systems and all. So that's it for today. I hope I helped you guys out. I'm still in the camp that this market is in bull mode and going to continue higher until something happens that changes the landscape. So the status quo for the market is buy any consolidation, pullback, sell off, whatever. And many stocks are in extended runs. Many stocks are breaking out, and the market in itself is in go mode and looking past what's going on in the Middle East. Either A, it doesn't care, or it doesn't care about what will affect the economy, which is the Strait of Hormuz. Well, take care, everyone. Have a nice weekend. And bye-bye. I think I did good.